All right, so welcome to another deep dive. Today, we're going to be looking at India's stock market.
Okay.
Specifically, some projections and insights from Volatility Coaches of India's newsletter. It's dated January 19th, 2025.
Right.
And if you're wondering where to put your money this year, for some potentially good returns,
Yeah.
this one's for you.
For sure.
We're going to be talking about the projected returns for the Indian stock market, potential strategies to maximize your investments. Really interesting stuff.
Yeah, this newsletter is great because it kind of blends this raw data with some really smart observations.
Yeah.
So it makes it, I think, a really useful tool for anyone who's interested in the Indian market.
Absolutely. And that's why we're diving into it today.
Yeah.
So let's just jump right in.
Okay.
The newsletter uses something called the buffet indicator to project a 6.2% annual return for the Indian stock market.
Right.
And there's an original and a modified version,
Okay.
both arriving at the same figure. So can you explain what this Buffett indicator is and how it works?
Yeah, so the Buffett indicator, it's named after, Warren Buffett, the famous investor.
Of course.
It's basically a way to kind of look at the stock market and see if it's overpriced or if it's a good deal.
Okay.
And how it's calculated is they compare the total value of the stock market to the country's GDP, gross domestic product.
Gotcha.
And so basically a high ratio might mean that the market is too expensive.
Okay.
And a low one might be signaling that it's a buying opportunity.
That makes sense.
Yeah.
So this 6.2% projection for India, what exactly makes up that number?
So it's broken down into three parts. You have 6.86% coming from projected economic growth,
Okay.
which is positive.
Yeah.
Then there's a 1.5% dividend yield, meaning you can expect at least that return just from dividends.
Gotcha.
And then finally, there's a factor called valuation reverse to the mean,
Okay.
which contributes negative 2.17%.
Interesting. I am curious about this valuation reverse to the mean. What does that mean, and how does it affect this overall projection?
So imagine you have a pendulum
Okay.
and it's swinging, right? If it swings too far one way, eventually it's going to swing back towards the middle.
Yeah.
So that's similar to what valuation reverse to the mean kind of implies.
Okay.
If a market is currently overvalued or undervalued, it's expected to move back towards its historical average valuation.
Gotcha.
So in this case, the negative contribution suggests that the Indian market might be a bit overvalued right now
Okay.
and could correct itself slightly. However, even with this correction, the total projected return is still a healthy 6.2%. This suggests that buying opportunities might emerge as the market corrects.
Yeah.
So keeping an eye on undervalued sectors could be beneficial.
Okay.
This makes sense.
Yeah, absolutely.
Okay, cool.
So even with a potential market correction, the outlook is positive.
Yeah.
The newsletter also has this section called Notes and Observations
Yeah.
with some interesting investment strategies based on different nifty levels.
Yeah, and that's where the rubber meets the road,
Right.
You're taking this data and then turning it into, what do you actually do?
Exactly. For instance, it suggests converting debt to equity if the Nifty drops below 23,000, and even converting gold and fixed deposits to equity if it falls below 22,000.
Wow.
That sounds a little risky.
Yeah.
What's the thinking behind that?
So it's about recognizing when to buy low.
Okay.
So if the market dips, asset prices are going to usually fall, creating an opportunity to buy equities at a potentially lower cost. So this suggestion to convert assets like gold and fixed deposits to equity at a certain nifty level is based on the idea that buying equities at a lower price could lead to higher returns when the market recovers.
But wouldn't shifting from gold to equity during a downturn contradict the principle of diversification?
Yeah.
Isn't gold supposed to be a safe haven during uncertainty?
You're right. Diversification is important. But this advice kind of emphasizes seizing those potential buying opportunities.
Okay.
It's a calculated risk, betting that the market will rebound
Okay.
and equities will outperform other assets in the long run. It's not a recommendation for everybody,
Yeah.
and it really depends on your risk tolerance and your investment goals.
Right.
But it does highlight how the newsletter views the potential of the Indian market,
Right.
even in a potential downturn.
That's an interesting perspective. So it's about weighing the potential rewards against the risks.
Exactly. Every investment decision involves a trade-off.
Okay. Moving on, the newsletter also recommends focusing on large cap and momentum funds in the current market.
Yeah.
Why these specific types of funds?
So large cap funds invest in companies with a large market capitalization, making them generally more stable than smaller companies.
Okay.
And then momentum funds focus on stocks with strong upward price trends.
Gotcha.
So in a market that is expected to grow, but also potentially experience some correction.
These funds could offer a balance between stability and growth potential.
I see. So large caps for stability and momentum funds to ride the upward trend.
Exactly.
Now let's shift gears and zoom in on specific sectors.
All right.
The newsletter highlights banking, finance, IT, and pharma as key areas to focus on.
Oh, we have some data to unpack here.
Yeah.
So looking at sector-specific PE ratios and dividend yields can give us a clearer understanding of their performance and their potential.
Great. Let's start with banking and finance. What's driving their importance?
So banking and finance, these are cornerstones of any economy, including India. As businesses and infrastructure projects grow, demand for financial services rises.
Yeah.
This fuels the growth of these sectors.
Right.
They have relatively healthy PE ratios and offer decent dividend yields, indicating potential for continued growth.
So solid performance with a promising outlook.
Yeah.
What about IT?
Yeah.
India is a major player in that sector. Absolutely.
Yeah.
IT remains a significant growth driver for India, benefiting from a large skilled workforce, competitive labor costs, and increasing global demand for digital services.
Right.
So if we look at the data here, we see a slightly higher PE ratio for IT,
Okay.
suggesting that investors are confident about its future prospects despite a slightly lower dividend yield compared to banking and finance.
Interesting. So IT is seen as a higher growth, potentially higher risk sector.
Yeah, I think that's a good way to put it.
And lastly, pharma.
Yes.
What insights can we get from the data?
So India's pharmaceutical industry has been growing steadily, driven by rising healthcare costs, increased access to medicines,
Yeah.
and a robust manufacturing base. The data shows a moderate PE ratio for pharma, suggesting a potentially less volatile but still attractive investment option
Okay.
with a reasonable dividend yield.
So we have banking and finance, IT and pharma,
Yep.
all crucial to the Indian economy and showing potential for growth, each with its own risk profile. How would you compare and contrast these sectors and which might hold the most promise for growth?
That's a tough one.
Yeah.
All four sectors have strong potential. However, if I had to pick, I'd say IT and pharma
Okay.
might offer more significant growth opportunities in the long term.
Yeah.
They represent industries that are expected to see continued global demand and innovation.
That makes sense. IT and pharma seem to be the favorites for long-term growth.
Yeah.
Now, let's move on to market sentiment.
Okay.
The newsletter gives us a timeline showing how sentiment shifted between positive and negative throughout 2022, 2023, and 2024.
Okay.
Can you walk us through these changes?
Certainly. So let's start with 2022. It began with a generally negative trend, with the Nifty dropping to 15,863 on March 8th.
Okay.
But by March 17th, sentiment turned positive,
Wow.
with the Nifty reaching 17,287.
Wow.
This was likely driven by positive global cues or potentially some domestic policy announcements.
Interesting. It seems like global factors play a big role, too.
Oh yeah, for sure.
What about 2023?
So the market kind of stayed mostly negative in the first quarter of 2023.
Okay.
However, April 2023 marked a major turning point
Mm-hmm.
where sentiment shifted positively.
All right.
This was probably influenced by improving economic indicators
Okay.
or positive corporate earnings. But this positive sentiment doesn't last,
Uh-oh.
and by August 18th, we see a shift back towards negativity,
Oh, wow.
potentially triggered by global uncertainties
Mhm.
or concerns about inflation.
So a lot of back and forth.
Yeah, a lot of volatility.
What about those other dates that are mentioned, like September 1st, October 20th,
Yeah.
November 10th? What caused those shifts in sentiment?
Well, I think these dates just kind of highlight the volatile nature of the market.
Okay.
So September 1st brought a positive close,
Mm-hmm.
signaling a return of investor confidence. This positive momentum continued until October 20th,
Gotcha.
which marked the beginning of a negative trend, likely influenced by global market corrections or profit-taking by investors. Finally, November 10th, 2023, saw a shift back to a positive sentiment
Yeah.
that continues to hold, suggesting growing confidence in the Indian market.
It's fascinating how these global events and investor behavior can impact market sentiment so much.
Oh yeah, absolutely.
So the current outlook is positive.
Yes.
How long do you think this positive sentiment will last?
It's hard to say for certain.
Yeah.
While the current data suggests a positive trajectory, remember that the market is constantly evolving and sentiment can change quickly. What's important is to stay informed
Yeah.
and monitor those key parameters we discussed earlier,
Right.
like, PE ratios, dividend yields, and
Yeah.
global economic trends.
Right. Staying informed is key.
Yeah.
Now, before we move on, I want to briefly touch on those additional RVCC parameters mentioned in the newsletter.
Okay.
We got PE, PB, MG, RSI, FII, net open interest, Nifty values, and VIX.
Yeah,
They seem like a lot to keep track of.
they are a lot.
Are they all equally important?
They're all pieces of the puzzle, but some might be more relevant to individual investors than others.
Cool.
For example, focus on the PE ratio. It's a quick indicator of whether a sector is overvalued or offers potential for growth.
Gotcha.
It's a simple but powerful tool to use.
So prioritize and focus on the most useful ones.
Right.
What about FII net open interest? How can that be helpful for an individual investor?
So tracking FII net open interest can give you insights into how large institutional investors are positioning themselves,
Okay.
which can sometimes signal emerging trends.
Interesting.
While you shouldn't base your decisions solely on their actions,
Yeah,
it's another data point to consider.
that's helpful.
Yeah.
Now let's look at the sectoral index provided in the newsletter.
Right.
How should our listener use this information, and what key takeaways should they consider when making investment decisions?
So the sectoral index is a valuable tool that allows you to compare the performance and valuation of different sectors within the Indian stock market.
Okay.
It provides a snapshot of key metrics like PE ratio, PB ratio, and dividend yield for each sector, which allows you to identify sectors that are potentially overvalued or undervalued.
Gotcha.
For example, if you're looking for potentially undervalued sectors, you might focus on those with lower PE ratios compared to the overall market.
So it's about comparing and contrasting to find potential opportunities.
Exactly.
This is all great information. I think we've covered a lot of ground here, but we're not done yet.
Oh, there's more.
Stay tuned, because in part 2 of this deep dive, we'll continue our exploration of the Indian stock market with even more in-depth analysis and insights.
Looking forward to it.
See you soon.
It's like having a specialized toolkit.
Right.
Each parameter helps you assess a different aspect of the market,
Yeah.
giving you a more complete picture of its health and potential.
That's a great analogy.
Yeah.
So looking at the sectoral index, what should our listener be paying attention to?
Yeah.
What are the key takeaways for making investment decisions?
So if we look at the data,
Yeah.
the Nifty Midcap 50 and Nifty Small Cap 100 have higher PE ratios compared to the Nifty 50.
Okay.
This indicates that investors have higher growth expectations for mid-cap and small-cap companies.
Higher growth potential often comes with higher risk.
Right, exactly.
So these mid-cap and small-cap companies,
Yeah.
while they might offer more room for growth, could also be more volatile.
Exactly. It's that classic risk-reward scenario.
Yeah.
Now, if you're looking for, like, steady dividend income,
Okay.
the Nifty 50, with its lower PE and a respectable dividend yield of 1.39
Yeah.
might be a better option. It really depends on your individual investment goals and risk tolerance.
That makes sense. So understanding the sectoral index can help tailor an investment strategy
Yeah.
to specific needs.
Sure.
Now, I want to go back to the newsletter's timeline for a moment.
Okay.
It shows a shift from negative market sentiment in late 2024
Yeah.
to positive sentiment starting November 10th, 2023. What do you think triggered this change, and what does it tell us about the market's potential going forward?
That shift is definitely interesting.
Yeah.
It's hard to pinpoint the exact cause without more context.
Okay.
Could in the combination of factors like positive corporate earnings reports, favorable government policies,
Yeah.
or even just a shift in global investor sentiment.
Interesting.
But the fact that this positive sentiment has persisted
Yeah.
does suggest increasing confidence in the Indian market.
So are we riding a wave of optimism right now?
I'd say cautious optimism is a better way to put it.
Okay.
The market is always evolving.
Right.
What's important is to stay informed,
Yeah.
monitor those key parameters that we talked about, and be prepared to adjust your investment strategies if needed.
Flexibility is key.
Yeah.
I'm curious about another point from the notes and observations section. It suggests converting flexi-cap funds to multi-cap funds.
Like,
the lower we go. Can you break that down for us?
so this suggestion likely refers to a scenario where the market is, going down.
Okay.
Flexi cap funds give fund managers more flexibility to shift between large cap, mid cap, and small cap stocks
Yeah.
based on market conditions.
Gotcha.
Multi-cap funds, on the other hand,
Yeah.
require a set percentage allocation to each market cap category,
Okay.
creating a more diversified approach.
So switching from flexi-cap to multi-cap during a downturn
Yeah.
would create a more balanced portfolio
Hmm.
and potentially mitigate losses.
Precisely. It's about spreading your risk
Okay.
across different market segments.
Interesting.
Yeah.
The newsletter then goes on to say, current focus large cap funds and momentum funds. Why the emphasis on those?
So remember, this newsletter was published
Yeah.
when the Nifty was around 23,203.
Right.
So in a market that's expected to have some correction,
Yeah.
but still has a positive growth outlook,
Mm-hmm.
focusing on large cap and momentum funds
Okay.
could be a balanced approach.
Yeah.
Large cap funds, as we discussed earlier, provide stability,
Right.
while momentum funds aim to capitalize on upward trends,
Yeah.
potentially maximizing returns.
So these recommendations are building on each other, creating kind of roadmap for navigating the market.
Yeah, I think that's a good way to look at it.
This is all really helpful.
Good.
But aside from the data and insights that we've already discussed,
Yeah.
what other factors should our listener keep in mind as we move forward?
That's a great question. It's important to remember that the Indian market doesn't operate in isolation.
Okay.
Global economic conditions
Right.
can significantly impact its performance.
Yeah.
Things like recessions in major economies, geopolitical tensions, or changes in global trade policies
Yeah.
can all have ripple effects.
So keeping an eye on the global landscape is just as important as understanding the Indian market itself.
Yeah, absolutely.
What else?
Domestic political and economic policies are crucial as well.
Okay.
Government policies related to things like taxation, infrastructure spending,
Yeah.
and foreign investment can directly impact market sentiment and performance.
Right. So staying informed about those developments is key.
For sure.
Anything else?
Don't underestimate the power of investor sentiment.
Okay.
News, social media,
Yeah.
even word of mouth can influence how people perceive the market,
Right.
leading to shifts in buying and selling activity.
It's a fascinating interplay of data analysis and psychology.
Oh, it is.
It seems like there's always more to learn and consider when it comes to investing.
Always something new.
What stands out to you as the most crucial thing for our listener to remember as they navigate this information and think about their own investments?
I think the key takeaway here is that there's no one-size-fits-all approach to investing.
Yeah.
Your investment strategy should align with your individual goals, risk tolerance,
Right.
and your financial situation. The data and insights that we've discussed
Yeah.
provide a framework for understanding the market,
Mm-hmm.
but it's important to apply this knowledge in a way that makes sense for you.
That's a great point. It's about taking this information and making it work for you.
Exactly.
We've covered a lot of ground today,
We have?
but there's still more to explore.
Oh, yeah.
Stay tuned for part 3 of this deep dive,
Right.
where we'll wrap up our analysis
Okay.
and provide even more actionable insights for our listener. All right, so welcome back to our deep dive into the Indian stock market. We've covered a lot of ground,
Yeah, we have.
from projected returns and market trends to sector analysis and even investor sentiment.
We've also explored some really valuable tools,
Yeah,
like the RVCC parameters and the sectoral index,
right.
to give you a well-rounded view of the market.
Exactly. Now, before we wrap up, there's one last point from the newsletter I want to touch on.
Okay.
It suggests converting fixed deposits and even gold to equity if the Nifty falls below 22,000.
Right.
We talked about buying during market dips, but this seems pretty drastic,
It is.
especially since gold is usually considered a safe haven, right?
Yeah. It's definitely it's a bold move.
Yeah.
It's one that requires careful consideration.
Okay.
Remember that this strategy is based on the idea that the market will bounce back,
Right.
allowing you to benefit from buying equities at a lower price.
So it's a bet on the long-term growth potential of the Indian market.
Yes.
Even suggesting that gold might not offer the same returns as equities in a bullish scenario.
Precisely. It's shifting from a defensive strategy
Okay.
to an offensive one,
Right.
anticipating a swing back in favor of equities.
That's what I find so interesting about this recommendation. It
Yeah.
challenges the traditional thinking of holding on to gold during uncertain times. It's almost like saying that even in a potential downturn, the Indian market's growth story is compelling enough to warrant calculated risk
Yeah.
and shift assets towards equities.
That's a great way to put it. It highlights that that optimistic outlook for the Indian economy.
Of course, this isn't a strategy for everyone.
Oh, no, definitely not.
It depends on individual risk tolerance, investment goals, and, the overall economic climate.
Absolutely.
Right.
It's always crucial to talk to a financial advisor.
Yeah.
Do your own research before making any major investment decisions.
Well said.
Thanks.
I think this deep dive has been incredibly insightful.
Yeah, it did have.
We've uncovered so much valuable information from from the Volatility Coaches of India newsletter, understanding projected returns, analyzing market trends and specific sectors, and even learning how to interpret market sentiment.
And most importantly, you now have the knowledge and the tools to make more informed investment decisions.
Exactly. And as we conclude, I want to leave you with one final thought. While the data that we've discussed paints a pretty positive picture for the Indian stock market, remember that global events can always, impact performance.
Yeah.
Staying informed, diversifying your portfolio.
For sure.
And being adaptable are crucial in navigating the world of investing.
It's a dynamic world out there.
It is. So stay curious.
Yeah.
Stay informed.
Absolutely.
And keep exploring. This is all really exciting stuff.
It is. I'm excited to see what the future holds.
Me too.